In 2025, the richest 10% control more than 60% of all private wealth, an historic high that didn't happen by accident. While most people watched wages flatline and buying a home slip out of reach, asset owners rode a surge fueled by central banks, artificial intelligence-powered tech giants, and rules written in their favor. Why does wealth accelerate for a few, even as the rest fall behind? The mechanisms powering this relentless concentration are compounding returns, asset inflation, and structures that lock in gains, and they are more visible and consequential than ever. So how are the ultra-wealthy pulling even further ahead, and what are the unseen forces keeping them there? The real story starts here. When the return on capital outpaces the rate of economic growth, wealth naturally pools at the top. This is the core of Thomas Piketty's R greater than G concept, where R stands for the annual rate of return on capital, and G represents the growth rate of the economy as a whole. In practice, this means that money invested in stocks, real estate, or private companies tends to multiply faster than wages or GDP. Over decades, this gap compounds. The World Inequality Database shows that in 2025, wealth inequality is growing even faster than income inequality, with asset returns in equities, private markets, and real estate delivering double-digit gains for those who already have substantial holdings. The rich are not just earning more, they are earning at a rate that outstrips the pace of the broader economy. This mechanism has held firm for generations, surviving policy debates, market cycles, and even global crises. The result is a world where capital begets more capital, while labor struggles to keep up. As capital compounds, the gap between those who own assets and those who rely on wages only widens. This is not a fluke or a temporary trend. It is a structural feature that explains why wealth, once accumulated, accelerates away from the rest of society. Year after year, the surge of liquidity from 2020 through 2022 unleashed a force that reshaped financial markets and deepened the wealth divide. The Federal Reserve balance sheet, which had hovered near $4.1 trillion at the close of 2019, ballooned to almost $9 trillion by March 2022. This was not a subtle shift. Over $4.8 trillion in new money entered the system in just 2 years, flooding banks, asset managers, and institutional investors with cash. While the stated aim was to stabilize the economy, the side effect was a historic run-up in asset prices. The S&P 500 index soared, climbing from around 3,230 at the end of 2019 to over 4,766 by the end of 2021, with further gains pushing it past 5,600 by late 2025. Real estate followed a similar path, with national home prices rising more than 40% between 2020 and 2022. This easy money did not flow evenly. The top 10%, already holding the bulk of stocks and property, captured most of the gains. In 2025, the World Inequality Database reports that the richest decile owns over 60% of all private wealth. For those with large portfolios, asset inflation meant double-digit returns with little effort, while wage growth for most workers remained flat. Even as the Fed began to shrink its balance sheet after June 2022, asset prices stayed elevated, locking in the windfall for those already invested. The result was a structural re-rating of wealth, powered by monetary policy, that left the rich even further ahead. This monetary backdrop set the stage for the firm-level strategies and market mechanisms that would continue to multiply fortunes at the top. In 2025, few stories capture the pace of new wealth like Nvidia's meteoric rise. At the heart of this surge stands Jensen Huang, whose net worth soared from $50 billion to over $110 billion in just 12 months. The engine behind these gains was not just luck or timing, it was the world's insatiable demand for artificial intelligence hardware. Nvidia's H100 chips, crucial for training and running the largest artificial intelligence models, became so scarce that tech giants raced to secure multi-year supply contracts, pushing prices and valuations ever higher. Securities and Exchange Commission filings from 2025 show that more than 80% of NVIDIA's incremental data center sales went to a handful of hyperscalers, locking out smaller players and creating a bidding war for compute. NVIDIA's board responded with record-breaking buybacks and option grants, a move that funneled billions directly to top executives and major shareholders. For Jensen Huang and his inner circle, the combination of hardware scarcity, strategic buybacks, and explosive market demand turned stock options into fortunes almost overnight. The result is a vivid demonstration of how, in the age of artificial intelligence, those positioned at the right bottleneck can see their wealth multiply faster than at any point in modern history. Stephen Schwarzman's name has become nearly synonymous with the new era of institutional landlords. In early 2025, Blackstone's real estate arm managed assets worth over $1.5 trillion, with a growing share concentrated in residential housing. The institutional grip on the housing market tightened as corporate landlords increased their share of single-family home purchases to 26.8%, up from just 18.5% 5 years earlier. Sunbelt cities such as Phoenix and Atlanta saw the sharpest effects. Data from the Private Equity Stakeholder Project shows above-average eviction filings and rent increases in portfolios managed by firms such as Blackstone, Invitation Homes, and American Homes for Rent. SEC filings reveal that as rents climbed 6 to 9% year over year in these regions, dividends and management fees flowed back to executives and limited partners, including public pension funds. For tenants, this translated into higher housing costs, greater instability, and fewer options to buy or even stay in their homes. The slow, methodical consolidation of housing wealth has shifted the balance of power from local owners to global investors, extracting value from communities and channeling it to the top of the financial pyramid. Carried interest remains one of the most effective tools for amplifying wealth at the top. In 2025, private equity and hedge fund managers continue to have their share of investment profits taxed at the capital gains rate, often around 20%, instead of the higher ordinary income rate paid by most workers. Congressional efforts to close this gap stalled again in early 2025, with final committee records showing the carried interest provision quietly dropped after heavy industry lobbying. The result? Billions in profits flow to fund managers, taxed far below the rate applied to a typical salary. Family trusts and offshore entities add another layer to this architecture. ProPublica's 2025 reporting documents a surge in elite family offices moving assets to states like South Dakota and to Singapore, where oversight remains light and disclosure minimal. These trusts shield wealth from both taxes and public scrutiny, preserving fortunes for future generations. Meanwhile, the much-touted OECD Global Minimum Tax, Pillar 2, has yet to deliver on its promise. Despite headline commitments, multinationals in 2025 still use complex accounting to keep effective rates well below 15%, as revealed by new disclosures and Big Four advisory memos. These legal structures ensure that profits, once earned, rarely leave the orbit of those who already own them. Buybacks are rewriting the rules of corporate wealth in 2025. S&P 500 companies executed over $1 trillion in share repurchases this year, setting a new record and outpacing dividends for the fourth year in a row. These buybacks funnel cash directly to shareholders, and the vast majority of gains flow to the wealthiest investors, the top 1% who hold the lion's share of equity. Behind these decisions stands a concentrated bloc: BlackRock, Vanguard, and State Street. Together, the Big Three control about a quarter of the voting power at nearly 9 out of 10 large public companies. Their stewardship reports show a consistent pattern: voting down proposals that would curb buybacks or raise wages, and prioritizing returns to shareholders. Even as they roll out pass-through voting programs, most investors default to the manager's choices, locking in the Big Three's influence. The result is a feedback loop. Record profits drive record buybacks, which in turn boost executive compensation and shareholder wealth, reinforcing the dominance of those already at the top. The median worker in 2025 faces a reality that numbers alone can't soften. According to the Bureau of Labor Statistics, real median wages have barely budged over the past 3 years, even as the cost of living continues to climb. For millions, paychecks stretch thinner each month, while the promise of upward mobility drifts further out of reach. Meanwhile, the machinery defending the status quo grows more powerful. Open secrets. Data reveals that lobbying by financial, real estate, and tech sectors reached an all-time high in 2025, with over $4.2 billion spent to influence lawmakers and block reforms that might narrow the gap. Behind the scenes, the groundwork is being laid for the largest wealth transfer in history. UBS projects that $83 trillion will move from one generation to the next by 2045, with most of it locked inside the same circles that already control the nation's fortunes. The result is a system where the odds of breaking through are shrinking, and the scale of future concentration is only set to grow. Today, 3 asset managers influence over $20 trillion. That is power that shapes markets, policies, and lives. As this concentration accelerates, the rules of the game grow harder to change. The divide is not just about wealth, it is about who sets the future. The next move belongs to all of us. What is yours?